What are the tax implications of an irrevocable trust brokerage account? Have you ever wondered how an irrevocable trust brokerage account affects your taxes? This topic is essential for anyone considering estate planning. Let's break it down in simple terms. An irrevocable trust brokerage account is a special type of account where you place assets like stocks or bonds into a trust that you cannot change once established. When you create this trust, you give up control over these assets, and it becomes a separate legal entity for tax purposes. First, let's talk about taxes. An irrevocable trust has its own tax identification number. This means it must file its own income tax returns. Unlike revocable trusts, which are ignored for tax purposes, irrevocable trusts are treated as separate taxpayers. Now, what about the income generated in this account? Income from dividends, interest, or capital gains can be taxed either to the trust or to the beneficiaries. If the trust keeps the income, it pays taxes at higher rates. If the income is distributed to beneficiaries, they pay taxes at their individual rates. There are two types of irrevocable trusts, grantor and non-grantor. In a grantor irrevocable trust, the grantor retains some powers, which means the income is taxed to the grantor. In a non-grantor irrevocable trust, the trust or beneficiaries are responsible for paying the income tax. Next, let's consider estate tax. When you transfer assets into an irrevocable trust, those assets are generally removed from your taxable estate. This can lower your estate tax when you pass away. However, since you no longer own the assets, you do not receive a stepped-up basis. This could lead to higher capital gains taxes for your beneficiaries when they sell the assets. Speaking of capital gains, any gains from selling assets in the trust are taxed based on whether they are retained or distributed. Trust tax rates can be higher than individual rates, so it's smart to plan distributions carefully to minimize taxes. Using an irrevocable trust brokerage account can help protect your assets from estate taxes while providing for your beneficiaries. It's essential for trustees to manage distributions wisely to optimize tax efficiency. Estate planning attorneys often guide clients on the tax implications of these trusts, especially regarding the loss of control and potential impacts on Medicaid eligibility. Properly drafted trust documents will specify how income and principal distributions are handled, which affects who pays the taxes and when. Understanding these tax implications is vital for effective estate planning.